Welcome to our third webinar, and I'm Steve Meldrum from Swell. We are going to go through tax-free retirement today. So I wanted to start with a quote, one of my favorites, and I think it's really relevant to today's environment. I'll give you a moment to read that. If you were in our last two webinars, I put up a cartoon. I think this relates as well, but given the situation that we're in, we have to start being creative, look for some new innovative ideas, and we'll go through that today. In the past, I've done different speaking gigs for the dental community, whether it be at PDC, U of A, U of S, and so on and so forth. That, coupled with the fact that I have three brother-in-laws in the dental field, two general dentists, one specialist, I've got to learn a lot about their viewpoints and your viewpoints. And a few things that come true each time are what they want. They want to save taxes now, they want to save taxes in the future, and they want to figure out efficient ways to transfer the money to their children or causes that they care about. I think it's important for us to realize how taxes occur for a professional corporation today. This is looking at Alberta. The first $500,000 you make, you pay 11% tax. Over $500,000, you'll pay 25% tax. And if by chance you retain any money inside your corporation, you can pay upwards of 48.67% tax. You'll notice between the corporation and the personal side, anytime that we move money across that barrier, we're going to be paying tax. And the more income you earn, the more taxes you'll pay. So that's where the current problems arise now. Future tax. If you decide to keep money inside your corporation and to invest, eventually you're going to have, let me just manage here. Eventually you're going to have a future tax liability. We call it double tax because you may have tax when you sell that investment, plus tax when you cross the corporate line over to the personal side. So in our last webinars, we had talked about kind of a mechanism to make reduction or elimination of tax, and that was to put the money that you earn inside an insurance policy. There's a lot of features such as tax deferral inside an insurance policy, and we would use those. The struggle was we only had the best benefits when we eventually died using the capital dividend account, as you can see on the bottom. However, today we're going to talk about potentially tax-free retirement and how we can use it without having to die. It's important for us to realize how an insurance policy can be formed as an investment. Particularly the type we speak of, it would receive dividends, and these dividends, pardon me, these dividends would be able to accumulate tax-free within the policy. And it builds up what we call cash value, or essentially equity inside the policy. Nice thing for dentists is it cannot go negative, so you cannot have a negative year in any crisis. And there's gains that are received not just by investments, but other things like mortality gains, cost reductions, and so on and so forth. So fast tracking us to retirement. What does it look like when we retire? There's a few different methodologies. First, the do nothing plan. And this is when you keep the money inside your corporation, you invest it in, the market, mutual funds, stocks, any type of investment vehicle. And what happens is when we decide to sell the investment, because we need the money personally, we're going to pay a tax on the investment as well as a tax when we cross it from corporate to personal. So potentially two layers of tax there. What we can do alternatively is look for single tax. And with our example here, we have the corporation putting retained earnings or extra money into an insurance policy, okay? And at some point, the corporation will decide that they want to access money out of that insurance policy. One of the better ways to do that is to go to a bank and receive a loan based on the cash value or based on the equity of that insurance policy. And we do that so that we don't cause any tax triggers from cashing out or redeeming the policy. So in this example, you'll see money's gone into the policy, it's grown tax sheltered. The bank will provide a loan, and then with that corporate loan, if the corporation wishes, they can move that money over to the person. If they do that, there will be a layer of tax to the individual. So, better than one layer of tax, or better than two layers is one layer. And then there's another alternative that we wanted to show you, which is potentially no tax. Similar model, but you'll notice that the bank is on the personal side or the right-hand side of the column. And that's because same effect, money goes in the policy, it's used as collateral to the bank, and the banks are willing to lend quite high, upwards of 90% on retirement. So they will lend 90% of your cash value. If the bank uses that corporate asset, they can provide a bank loan to that individual. Now we need to be cautious, especially if you're an accountant or a lawyer. You're going to want to highlight this to your dental clients, or if you're a dentist, you want to have the discussion with your professional, because there's potential shareholder benefit issues or 15(1) issues, okay? And that's because anytime that you use a corporate asset for a personal benefit, there's a potential shareholder issue. One way that a lot of people are trying to mitigate that is through a guarantee fee. If you see here at the bottom, oops, let me go back up. The guarantee fee is where the individual will provide a nominal fee, usually 1 to 3%, to the corporation. That guarantee fee for using their asset is taxable to the corporation, but it allows the shareholder to have the benefits of that security and that collateral. You'll see how we put it taxable again to the corporation. So a guarantee fee is oftentimes used or proposed by advisors to mitigate or subside those issues. So if this were the case, in this situation, you'd potentially have no tax from the government. An alternative would be just the interest loan payments to the bank, which we could form as a small level of tax. I wanted to give you now an example, and the example that I'm going to show is a 40-year-old male non-smoker. And this 40-year-old puts $50,000 a year into the insurance policy. And you'll see on the first arrow, we have that after 10 years, they don't put any more money in. This is a policy that after 20 years, they're deciding that they want to take out retirement income and take out income from this policy that's been growing tax sheltered. If they do, we will show here that for the next 20 years, they can pull out $35,000 a year, if you see the second arrow. Now, I want to point out here that if you started with this strategy, immediately, the day that you start, they would have a net estate value, and net estate value means the value to the individual, not just the corporation, but once all taxes are factored in, this is the benefit to the individual. It'd be 1.47 million compared to that 50,000 once it flows through the corp and across the tax line to the individual, it'd only be 37% or 37,000. And we assumed a 6% return with a mixture between interest, dividends, and capital gains. So pretty reasonable for to compare across, but wanted to highlight the immediate benefits of having an insurance policy and its death benefit. So again, I said that they paid for 20 years, or they received income in retirement for 20 years. The corporation, this is corporate borrowing, the corporation receives the bank loan, and then they're going to make payments to the shareholder. When they do that, the corporation, there's that single layer of tax. But if we do that until life expectancy, where the LE is, you'll see that the insurance is still a $1 million benefit compared to the alternative investment, which is only about $436,000. So about 129% more value to your corporation, or ultimately your estate, in this case, your loved ones, your charitable causes, all those kinds of things. I wanted to give another alternative, and this is the shareholder borrowing. Again, this is when there's potentially no tax, but we need to have that guarantee fee to avoid shareholder benefit issues. Similar scenario, First Arrow, they put in $50,000 a year for 10 years. When they retire at age 60, the shareholder is going to use the insurance policy that's held by the corporation as security for a personal loan. And we can see here that they get a higher level of income. They get $49,000 a year for the next 20 years. If we take a look at what that looks like, life expectancy, they still get that $1 million of death benefit paid out, compared to an alternative investment where they wouldn't actually have anything left for the estate. So I call that 1,000,000% more. But the whole point here is, if you do nothing, you're going to have a double layer of tax. Tax on selling your investment, and then a tax when you cross the line from corporate to personal. We can reduce that with corporate borrowing, where the corporation borrows from an institution with the insurance policy as security, and that creates single layer tax. And potentially the third alternative is no tax, where you have shareholder benefit issue or shareholder borrowing. Be cautious of shareholder benefit issues. Anything we would do, we talk to the accountant and make sure that they're comfortable and you're comfortable, and we all understand the pros and cons of each scenario. But for us, we wanted to just have a very quick highlight of those options for you today. If there was any questions, feel free to ask them in the chat box, and we're happy to help. Thank you for your time.